Over the last years, a new way to manage innovation has emerged. With the strong competition in the product market, shorter product life cycles, and the exponential growth in information and communication technologies, companies cannot produce everything by themselves. Increasingly, they must trust networks, new entrants, and specialized firms if they want to remain efficient and competitive. The proliferation of markets for technology have facilitated this link to companies, and licensing agreements are now the most important method for commercializing and diffusing new technologies outside the firm. In particular, licensing agreements are agreements through which the owner of the technology, that is called licensor, allows the owner party, that is called licensee, to make, sell, and use the technology without transferring its ownership. However, despite this surge in popularity, establishing a licensing agreement is not an easy task. Markets for technology are mainly characterized by asymmetric information between parties, difficulties in describing and evaluating this technology, uncertainty about the validity and applicability of the traded technology, and the risk of opportunistic behavior by licensees. Therefore, it is reasonable to expect that parties do not equally appropriate the total profits generated by the agreement. Instead, the output of any negotiation depends on the specific characteristics of the company, sector, and industry in which each licensing agreement is signed. Then, the question is, on what does the licensor appropriation capacity depend? Basically, this paper proposes that licensors' appropriation capacity is a function of licensors' bargaining power. That, in turn, depends on the existence of financial constraints and the presence of information asymmetries between the parties, and on the potential cost of imitation. That depends on the position that companies have on the industry. I tested the hypothesis using a sample of 107 US companies and 260 licensing agreements established during 1998 and 2009. The licensing data came from 4 sources: Google, Predica's Overview of Markets for Technology database, Highbeam Research, and SDC Platinum. The financial information came from the Compustat database, and the stock market information came from Center for Research in Security Prices. To analyze the impact on licensors' market value at the time of announcing the contract, I ran an event study. In particular, to compute the abnormal returns, I used the market model. I estimate the coefficients with ordinary least squares based on 200 trading days. And I employed the daily return of an equally weighted market portfolio as a reference. To avoid the inclusion of unrelated events that might influence stock returns, I used a 2-day event window that sets the event day, that means day 0, as the day of the announcement, and also considers the possibility that the event might have happened on the previous day, before closing of the stock market, that means day -1. The results of the paper showed that companies with cash constraints appropriate fewer benefits from licensing than do companies with no cash problems in terms of market value. That companies that license out under low information asymmetries, same sector, benefit more from licensing than do companies that license out under high information asymmetries, different sector, in terms of market value. That leaders in the sector benefit much less from licensing in terms of market value than do companies that are followers. That, in the specific context of licensing out in the same sector, leaders appropriate much less value than do companies that are followers. And finally, that the difference between being a leader and being a follower is less important when a company licenses out to a different sector. To conclude, just to say that knowing how the stock markets reacts to the announcement of licensing agreements is an important and interesting question because of four main things. First, because previous research has found that in an efficient market, the current share price is the best available estimate of a company's true value. Secondly, because previous research demonstrated that the initial stock market response to a key event is positively correlated with the company's long-term performance and the value of the event. Third, because usually managers' compensation are linked to the company's market value, and in order to maintain their jobs and their reputations and to receive higher salaries, managers will not make any strategic decision that could negatively influence this variable. Fourth, because it is necessary for companies to understand the signal that the market perceives at the time of licensing their technology. If a company licenses out its technology, does the market view that as a signal of superior technology or a signal that the company is incapable of commercializing their technology by itself? I really hope that you have enjoyed this video. For more information regarding this research, please visit the following webpage or write me an email. Thanks for your attention.